Good morning, everyone. Good morning. It is Monday, August 12th, 2024. It is so good to see you all this beautiful, amazing Monday morning right here in Austin, Texas. Thank you all so much for joining us this Monday morning. Monday morning touch point, lots to go over, lots going on this week. Not only is it a very important week for our industry, the fact that so much is changing at the cross of 11:59 p.m. tonight, at midnight tonight, broker commissions are decoupled from the MLS, meaning we will no longer see that commission field on the MLS. We had a really good meeting on Friday where we went over again. We've been going over these changes now for the past 8 weeks or so. We've done many contract proficiency challenges over the past 8 weeks using the new forms. So by now, all of us should be very much familiarized with the new forms because we've been doing a lot of practice contracts on the new forms and going over everything, talking about everything, not only on the Monday morning, but the Tuesday, or not so much on the Tuesday mentorship, but on the Wednesday morning Q&A, on the Wednesday morning contract review. We've been going over this on the Friday. So we're going to keep on going over this information. I'm also working on a really neat flow chart that's just about done. I just need a few more hours just to wrap a few things up on if this, then that. We ought to have that published here within the next few days or so. So be on the lookout for a really good, really well thought out flow chart. You meet a client or you meet a potential prospect and they don't want to pay. They want to pay. They're okay with paying. They're not okay with paying. You contact the listing agent. The seller's paying for the commission or the buyer's paying for the commission, whatever the case might be. So be on the lookout for a very, very well thought out flow chart. We've got it, I'd say about 90% complete or so. I just really want to just polish a few things up and clarify a few things. Now, I did have one question, which is an excellent question. I want to go ahead and address that today. What about open houses? Do you have to present that showing form for open houses? Well, the answer is no. When you are scheduling a private showing for a property, that's where you need that agreement. An open house is not a private showing. It's a public showing. So no need to have a bunch of those showing forms and people can't see the house during an open house unless you have that form. Absolutely not. No. There's a lot of misinformation out there when it comes to that specific form. If you are scheduling a private showing, then yes, absolutely, you would need that form, but not if you're doing a public showing. No need for that whatsoever. Now, if you meet someone at an open house and they want to see a property that's down the road, down the street, well, now you do need that representation agreement. You can select showing service under that rep agreement. You're covered. You're good to go on that. So if you did not participate in our Friday meeting, take a look at the recording. We went over a lot of different information. I even provided you all with scripts and process and all that. I also realized that I received quite a few emails after Friday over the weekend. People have a lot of questions, and that's totally fine. I'm addressing those. But over the next 24 hours or so, be on the lookout for a really, really awesome, really good flow chart that just walks you through the process. Well, let's go ahead and hit it hard. New listing to pending ratio. We're going to go over that. We're going to go over leading market indicators, activity index, lagging market indicators, months of inventory. And you all, I created what is now my favorite resource. I am in love with this new resource that I created. And it really, I'd say the inspiration came from the vendor that we had here on Friday. And he made a statement that properties that are priced at over 1 million, or maybe he said over 2 million, that there's something like 20 some months of inventory on that specific price point. And one of our amazing agents, and that would be Mr. Oliver Hall. So Oliver's here on this call. He's like, hey, is that true? And you know the saying that we have at Team Price. What's the saying that we have? Don't give your opinion when data proves a fact. So I put together a absolutely amazing, gorgeous resource that I want to share with you after we go over the new listing to pending ratio, after we go over the economic indicators for the week. And y'all, I'm in absolute love with this new resource. And I also have a few ideas on how to update the active residential listing, the sold distribution, and just add some of that data to those resources. I want to get your opinion on that. Let's go ahead and start updating that new listing to pending ratio. First thing we're going to do, as you know, is we're going to go backwards in time and see which agents just now updated all of the data for the previous weeks. I did an update yesterday, so we shouldn't see a lot of changes, but let's go ahead and just go backwards. We're going to go from July 29th all the way through August 5th. The only data that we're going to update is going to be the pending. Keep in mind that at the end of the day or the end of the week, at new price increase, price drop, back on the market, active under contract, it all locks in. The only thing that continues to update will be the pending, and that'll update for the next few weeks or so. So we're at 411. Keep in mind, these are for residential transactions. And we're going to go for the 6-county area. 6-county area, we're looking at Travis, Williamson, Bastrop, Hayes, Caldwell, along with Burnett counties. We're going to go from the 29th all the way through the 5th. We're going to click on pending. And this number is going to go from 411 to 417. That's going to give us a ratio of a 0.74. Not bad. I'll take that. Let's go ahead and update the previous week. That's going to be from the 22nd all the way through the 29th, 483. Let's go from the 15th to the 22nd, 488, 8 through the 15th, 8. Okay, so we're all set. We're good to go. Everything's updated. The reason we didn't spend a lot of time updating the previous week, so I went ahead and did that really early this morning, so we're all good on this. Now we can start updating this previous week. That's going to be from the 5th all the way through the 12th. Let us see if the drop in rates caused an increase in demand. That's the big thing that we're interested. Rates went down. I'm encouraged by what I saw. I've approved more contracts. I've had many conversations with you all saying, hey, Dan, this buyer that was just sitting on the sideline, all of a sudden we're under contract. So I'm very encouraged what's happening here within the team. Let's see if the entire 6-county market experienced the same thing that we've experienced. So far, number of new listings, we're at 956. Price increases, we are at 142. That's a drop from last week. Last week, beginning of the week, we always see an increase on the number of price increases in the beginning of the week. That's what builders like to do. And then we do notice that they backtrack. Then let's go ahead and go to price decreases. We're at 1713. Not bad. It's okay. 92%, a little bit higher than the previous week, but that's right in line. If I were to get the average going all the way back to April 1st, we're looking at exactly 92%. So we're holding steady at that 92%. That's the average from April 1st all the way to today, in essence. Let's go to back on the market. We are looking at 201 back on the market, 21%. Same thing. Let's do a really quick review. 19% is the average going all the way back to April 1st. We're at 21%. A little bit over, not a big deal. Active under contract, let's take a look at this. Nice. I'll take this. 415 active under contract. This is where you get to guess. Let's go ahead and get 5 guesses on how many properties went pending. Keep in mind, this is a lower number whenever we input this data for the first time. Last week, we had 417. What do you all think? Let's go ahead and get 5 guesses. Let's get 5 people over chat to write how many properties went pending. Melanie is going to start us at 267. Sonia coming in at 271. Bertina at a slightly bearish 202. We've got Kathy at a bullish 302. And we've got Seth coming in at 222. We've got our 5. Let us go ahead and just see what number we are looking at. We are looking at, you all, I'm excited. 260. Not bad. We're still at a 0.58 ratio. 956 properties came on the market. That's going to beat the previous week at 1,002, which beat the previous week at 938. We are going to end the day not at 1,100. I'd say closer to that 1,025-ish or so is where we're going to end. Are we going to beat 2 weeks ago at 1,028? We could very well beat the previous 2 or 3 weeks. 1,002, 956. We are going to get just a few more between now and 1159. Like I said, we're going to end at about 1,025-ish or so. But, 0.58 ratio, it's about in line with what we are seeing. What does that mean 3, 4, 5 weeks from now? That means that we're going to be around the 0.7 to 0.75 ratio. As you know, where does that put us? That puts us in that tangible increase in inventory. The average difference going all the way back to the beginning of April, it's about 356. So every week we just see about 300 or so listings being added to the market. So we still have not reached a record high on the number of active listings because we had so many listings go pending and expired last month into the summer, into the selling season. We do see this happen. We're going to go over active listings here in the next few minutes. But, a 0.58 going into the beginning of the school year, it's not great, but I'm glad it's over 0.5. That's going to end at about that 0.7 to 0.75. Let us look at the monthly data. First thing we're going to do is update the entire previous month. Let me see how many properties went pending for the entire month of July. We're at 1,706. The rest is all fully updated. Now we can focus in the entire month of August. This is going to give us a better picture on what is going on for the month, because when you look at the week over week, I overlap the weekends to see the kind of demand that we see over the weekends. A lot of properties go under contract over the weekend. So that's why I overlap those. But when you look at the monthly, it's just a fixed, what is it for the month? How many new listings? We're looking at 1,568, 1568. And what day is today? Only the 12th, you all. So I would say that chances are that we are going to beat last month. That's not an anomaly. You can see August 2013, we had more listings come on the market August 2023 as opposed to July of 2023. 3987 July 2023, 4142 August 2023. So far, we've got 1568. Last month, 3980. How many price increases so far this month? We are looking at 297. How many price drops? We're looking at 2762, 2762, 90%. That's the best percentage going all the way back to March of this year, where we were at 86%. August of last year, we were at 90% also. I am glad to see this number come down from that 94%. Two reasons. One, sellers and agents are pricing their homes better. I'm noticing that. The deals that are going under contract within that 14-day sweet spot, they are priced well. Right now, very few people are going to say, well, the Austin market's doing amazing. Now they're like, yeah, I see it's tough out there. I see that there are listings sitting in the market. Let's price it well. Many of our listings are going under contract within that sweet spot, 14 to 21 days, because you all are doing a really good job educating your sellers, using data to show them what to price their property. If you don't price it well in this market, you can't give it away. So that's why we're noticing a drop on that difference. Agents are doing a better job. Sellers are more realistic. They're pricing it well. Let's take a look at back on the market, see what's going on. I expect this number to go down because rates went down. When rates go down, people are more inclined to be qualified. They lock in their rates. They qualify for their property. 300, that's exactly what happened, 19%. We had a little bit of a run up in rates over the past few months, and we noticed that went up 16 to 19 to 22. That's where, client doesn't qualify for the property. They didn't lock in their rate. Rates go up. They do an extension. They do two extensions. The deal falls apart anyway. How many active under contract are we looking at? We're looking at 606. How many pending? We are looking at 434. Okay, so we're at a 0.56 for the entire month, and that does put us in that danger zone. Little bit of an update over the past week or so. We saw the improvement on demand because rates went down. But when you look at the entire month, a 0.60 does put us a little bit in that danger zone. And we're going to talk about market cycle and all that. How many closed so far this month? That's going to be 955. And how many withdrawn? 351. That's a pretty high number. And how many expired? That shouldn't be a high number at all. Only 121. 121 expired. Now, so far this year, 7,558 properties have withdrawn and expired so far this entire year. That is a large number. Imagine if you were to add half of those to the current inventory. That's amazing. That's a really, really large number. And we hit that record high of 992 properties that were withdrawn, not even expired, withdrawn from the market last month, July 2024. Let me go ahead and just move this out of the way and print this as a PDF so that we can review some of the graphs and get all of this information in front of you via a PDF so we can look at some of the cumulative data. Just give me 1 second so I can just select all of the different tabs and convert this to a PDF. It's important for us to just take a little bit of time just to look over absolutely everything. Okay, so there we have it. Let me go ahead and just put this on the other screen. It's publishing. It takes a few seconds to publish this as a PDF. Let me adjust this a little bit. So we can see this. This is all updated. Let's go ahead and take a look at some of the historical data. So when we look at weekly year over year, same week year over year, we've actually been down on the number of new listings entering the market compared to the same week last year. That is going to reverse itself this week. We will get more than 51 listings, additional new listings entering the market between now at 10:20 a.m. and 11:59 p.m. So this number is going to reverse itself. We've had 5 or 9 less price increases. I'd say that's going to reverse itself also. We've had 8 less price drops. Now, look what's happened. This is just amazing. We went from having triple-digit more price drops to just 8 less price drops, meaning we had 8 more price drops last year versus this year. This is going to be positive, but it's really interesting just to see so many triple digits and all of a sudden that reverses itself. Back on the market, 41 less back on the market this year versus last year. Now, the pending, and this is really what's kind of killing us right here, is we're just negative triple digits. We've got 2 weeks ago a negative 160. That's 15%, 9% previous, 10, 14, 10, 8, 8, 8, 9. And look at the ratio. Last year, we ended that week at a 0.80 ratio. The week before that, 0.82. And look at this year, 0.74. We're at a 0.58 right now. We're going to inch up to that 0.7 to 0.75. I'd say when it's all said and done, we're going to be at about a 0.72 ratio. Last year, 0.80 ratio. Let's look at the month. You can see that 0.56 ratio, and let's look at some graphs. This is the difference between new and pending for the month of August. So right now we're a 4.6% above average. So when you subtract the new listings versus the pending listings, we are positive 828 so far this month, meaning we've had 828 more new listings enter the market when you subtract the pending listings. What does that mean? Inventory is going up. This is every month of August going all the way back to the year 2000, and we're 4.6% above the average. What about the new listing to pending ratio? Here's that data. Last year, for the month of August, we were at 0.74. So far this month, we're at a 0.56. That's going to improve. It's not going to reach 0.7. No way it's going to reach 0.7. I would say that we're going to be very close to that 0.67, which is what we saw May of this year. July of last year, 0.83. July of this year, 0.75. Really quick recap, you all. A 1-to-1 ratio is that perfect market equilibrium. 1,000 listings come on the market, 1,000 listings leave the market. Inventory doesn't go up, doesn't go down. Anything under that point or that 1.0 ratio means inventory goes up. That means 1,000 listings come on the market, 900 listings leave the market. What do you have? You have a 0.9 ratio, meaning inventory went up by 100. If you have a 1.1 ratio, that means that 1,000 listings came on the market, 1,100 listings left the market. So you're now taking from existing inventory. So when you see that ratio over 1 for a substantial period of time, inventory plummets. That's what it is. And let me show you the graph. There's the ratio. So we're at a 0.58 right now. We have to go all the way back to 2003 to get a ratio that is under that 0.56. Did I say 0.58? We're at a 0.56. We have to go right there. 2003, where it was 0.55. And right now, we're at a 0.56. And that's why inventory is going up. Keep in mind, this is a leading market indicator. This tells us the strength of the market right now, the demand for homes right now, real time. I love lagging indicators, months of inventory, sold price. It's important for us to know that, but there's nothing more important than a leading market indicator. We can see that a 0.56 puts us at the lowest ratio so far, going all the way back to that 2003. Let's take a look at inventory. Here we've got active per 100,000 population. So even though inventory is increasing and we're bordering on the record high number of active listings, when you adjust it by population, we're still well below what we saw back in 2007, 2008, 2010, even 2011. So we're only down 2.5% from the historical average. Let's look at new listings for the month of August. So far, we've had 1,568 new listings come on the market. If you look at the cumulative, we are 11.6% above average. So I've got a few questions right here. Dan, what's going on with the market right now? Everything is dumping. So that is a direct message that I just received. And yes, we have a lot of fascinating and interesting things going on with the market right now. We've got the Dow Jones down 199 points. We're going to go over quite a few things. Well, asset prices are getting repriced. One could even say the bubble is popping. That's the bottom line. Just about every asset category at one point will have to, everything is overvalued except for forever stamps. Those maintain their value forever. Yeah, and this is just starting, you all. This is just starting. We've got another question right here. How soon might we see results of the recent interest rate cut on the market? Well, we're going to see, and I noticed that, Mike, you sent this to everyone, so I'll respond with your name. If you send me a direct message, I won't mention who you are. The rate cut, Mike, will provide a momentary influx of buyers to the market that were wanting to buy anyway. And it will be momentary, and it will not be substantial. Just hear me out on that. That's just a fact. It will not be substantial. Now, it'll increase demand a little bit. And right now we're at 6.375. We would need rates to go down to 4%, 3.5% for there to be this like substantial flood into the market. That ain't happening. Like, that's not going to happen. The only way that would happen is if the Fed starts buying mortgage-backed securities. That would be inflationary. They're not going to do that. Like, that world is over. For now, things are going to have to be just so bad for the Fed to come in and start buying mortgage-backed securities. I don't see that happening. 18 months, possibly 24 months. We have to be in an outright deflationary position for that to happen. Right? That's what's happening in China right now. They're not disinflation, meaning the rate of inflation is slowing down, but downright deflation, where everything is going down. That's when they'll start doing the QE, quantitative easement. Let's start buying mortgage-backed securities. We are months, if not years away. Do I think they're going to do that eventually? Yeah, I'd say historically they've got a pretty good pattern and track record of doing that. No, nowhere soon. So this momentary drop in rates, in which we certainly welcome, it has moved the market. It's moved the market as much it's going to move the market. Does that make sense? Good stuff. Let's go ahead and take a look at a few more data points right here. Okay, we looked at back on the market. Let's look at some cumulative pending. Cumulative pending, this is from January all the way through August. We can see that we hit a record high on the number of pending transactions back in 2020 at 42,309. We're at 28,889 cumulative pending, all of January all the way through August. So let's adjust this for population, and we can see that we're at 1,153 cumulative pending, adjusted for population. So this is where we do get the apples to apples comparison. Now, it is August 12th, so this number does not count every pending transaction that's going to be reported between August 12th and all the way to the end of August. So we can see this number go up. Okay, so we've got 41. Let's just add. It'll end at probably the 1,300 mark, and that does put us right around the 2009 to 2011. along with the 2002 type market. Now, keep in mind, this is adjusted for population. So we're down 11.7% compared to last year, which was down 11.9 compared to the year before, which was down 17.5. I would say we're hitting a record low on that. We'll have another year, in my opinion, where this will be around the 1200 mark when we revisit this data August of 2025. We're still going to be around here, and then from there we start going up. And what about sold? Let's take a look at sold. This is withdrawn, active minus pending, cumulative sold, adjusted for population. There we have it. Cumulative sold. Every single thing that has sold in our 6-county area, adjusted for population, we're at 787 right now. Once again, that does not include everything that will close in the month of August. That's going to be added to this number. Are we going to beat 891? No, we're not. I know that we're not because pendings are down year over year. So we're not going to get more sold properties when the number of pending properties are down, right? That just makes sense. If something doesn't go pending, it doesn't sell. So this number is going to be less than the 891. Whenever we update all of August, we're always going to revisit this information. But this is going to be, it's going to close right around that 825 mark. It's going to be better than 2009. It's not going to be better than 2010, 2011. It's going to be right around that range. That's what I forecast, just looking at demand, looking at what's going under contract. So there you have it, you all. This is a summary for the new listing to pending ratio. Overall, this is a little uptick that we noticed with rates. It's that 0.74 right there, that 0.85. As rates were going down, we hit that 7.1. The ratio dropped, and you can see this right here. So you can see that as rates improved, this red line going up means what? Well, it means that rates are improving. When the red line goes up, that means that rates go down. So what did we notice? Well, we noticed the new listing to pending ratio go up. But now you just have market forces that are beyond what rates are doing. And now you get into more of the psychology of the market, right? People logging into their retirement account, people reading the jobs report. And this is like, well, and you get into more of a deflationary mindset. And I would say that we now have some consumers that are entering that deflationary mindset. Well, what does that mean? It means that the decision that they make, it's like, if I know this property is going to be 5% less next month, why would I buy it this month? If I know that rates are going to be less next month and the prices are going to be less next month, why would I buy this month? And when enough people enter that deflationary mindset, just the market just does a really big pullback. And I'm not saying it's irrational or irrational. It really doesn't matter. It's just the psychology of the populace. Are we there yet? Are we there right now? We're at the tipping point of that. We're at the tipping point of that. And you can look at surveys between consumer confidence, between even looking at the Wells Fargo prospective buyer walkthrough. All of that points to an environment where the consumer is starting to make that decision. Let's go ahead and take a look at a few more things, you all. Let me go ahead and just close this. Take a look at rates. We are right now at 6.375. Let's look at the bond market really quick. Let me log into MBS Live, see what's going on with the bond market. Okay, well, the bond market is actually down 1.6 basis points, exactly where we were last week or last Friday. Not much change. We're bouncing between two different repricing lines. Now, this is going to be a hugely important week for rates. The big question is, did the market already price in what the market is expecting not only tomorrow, but also Wednesday? It's all about inflation this week. So we had two bond auctions. They came in a little bit better than expected. On the 3-month came in at 5.07, better than the previous, but not the 6-month. The 6-month actually went up 4.795 as opposed to the previous at 4.7. Tomorrow's going to be huge. 7:30 a.m., log into the Team Price Facebook group, and you're going to get a screenshot first thing in the morning at 0730 hours with PPI. It's all about inflation. If it comes in at forecast, I'd say you can expect a pullback in rates because the market is pricing this in. Y'all, if this comes in hotter than expected, oh my goodness, expect rates to go up. I mean, bottom line, same thing with more so on Wednesday. On Tuesday, we have the input side of inflation, the producer price index. What is the producer paying for that raw material? On Wednesday, we have the consumption side of that index. What is the consumer, you and I, what are we paying for things like groceries, owner's rent equivalent, and all of that stuff? That comes out on Wednesday, also at 0730. I'm going to do a screenshot, post it on the Facebook group. We're also going to go over this information a little bit on our Wednesday morning training. But this week is huge for rates. Why is this so important? Well, what in the world will the Fed do if for some reason inflation numbers come in hotter than expected? Everyone is expecting the Fed to drop rates next meeting by about 50 basis points. And there are videos online right now saying that the Fed needs to do an emergency meeting and go ahead and just do a 75 basis point immediately because the job market is deteriorating. But inflation versus maximum employment. The Fed will choose inflation. Unemployment is hard for a season. Inflation will ruin nations. They will accept a higher unemployment rate, a deteriorating job market to kill inflation. They will do that. And I hope they do that. I don't want a high unemployment rate, but inflation will absolutely destroy a nation. So we've got right here a comment. I was having this exact same talk with a buyer over the weekend. This is exactly how they are feeling. So thank you for sharing that, Bertina. And yeah, it's that deflationary mindset that clients will walk into. It's like, I'm just going to wait. Remember back on the really high inflation days, we're talking 10%. So I lived in Brazil when inflation got up to 100% a month. Imagine prices doubling every month. Every month the price doubles. Prices used to go up twice a day, 10 a.m., 3 to 4 p.m. Prices went up twice a day. Imagine that. You go to the store in the morning, it's one price. You go to the store in the afternoon, it's a whole nother price. When you got paid, guess how fast you spent that money? You did one of two things. You either converted that money to US dollars immediately and you paid a premium for it. You went to the black market, and the black market basically meant someone that you knew that knew someone that you met somewhere, and you exchanged the local currency to dollars because that would maintain its value. So you either converted your money to dollars immediately, or whatever you were thinking about buying, you bought it. Now, if you were saving money to buy something, then you would convert it to dollar, save that for a few months, and then convert it back to the local currency and then buy that immediately. You could not hold on to the local currency. And that was a high inflationary environment. You bought now because it was more expensive tomorrow. Isn't that what happened to Austin real estate? That's exactly what happened. From 2020 all the way to 2022, what was the mindset of the consumer? I know it was 500 yesterday. It's 525 today. Buy today for 550 because it's going to be 575 next month or next 6 months. That was the inflationary mindset. Buy now or else. Well, a deflationary mindset, the same thing happens in reverse. Why would I buy now when if I wait a few months, it's going to be less? And I'm hearing all over the place that the Fed is going to lower rates. So until they lower rates, I'm not going to move forward because the prices are going to go down and then rates are going to go down. And I'm just going to time the market perfectly. And at that absolute sweet spot, I'm going to move forward. Bottom line, every single one of those people that I had that conversation with back in 2008, 9, do you think any of them bought? Yo, it doesn't matter. It doesn't matter. Keep on staying in touch with your people, stack your pipeline, meet new people. Think about every single person that didn't buy in 2021 and they all said, well, I think the market is overvalued. I'll wait until it drops 10%. Are any of those people under contract right now? Guarantee you they're not. Guess what they're doing now? Well, they're waiting for another 15% price drop, even though the market's down 20% from May of 2022. Can't control when people buy. We can educate, we can empower, we can give data, but I am convinced that we have to meet that person when it makes sense for them. And we have to stay top of mind. We have to equip them with information. And when the time is ready, then they'll call us because they know who we are and you've been staying in touch with them. Then we go into Thursday. We've got more inflation data right there, a lot of it related to import-export pricing, which is an even better indication of inflation, in my personal opinion, because they don't play any games with that data. They don't do the owner's rent equivalent. They don't do substitution. They don't do hedonic adjustment and all of the fancy things that the government does in order to hide the true percentage increase in inflation. And if you want to do more study on that, all you have to do is just Google those three things: owner's rent equivalent, hedonic adjustment, and substitution. Those are the top three things that the Bureau for Labor and Statistics will do in order to make inflation look lower than it actually is. That's why you and I go to the grocery store and we're like, what are they talking about? 3, 4, or 5% inflation. This is up 10%. It's because of that nonsense that they pull. So hugely important week this week, you all. Very important. I'll certainly keep you all updated on what is going on. But so far, when you look at the bond market, we are down 1.9. I'll take that. But we're still in between two repricing lines. Don't expect lenders to move. Everyone is going to wait and see what the numbers look like over the next 24 to 48 hours. Where are we right now? Conventional 30-year fix, 6.375. 15 years, 6.125. FHA 6. VA, 6 1/8. USDA 6. Jumbo 30 years, 7 1/4. And then investor with 20% down, also 7 1/4. If you have any questions about rates, reach out to Robert. Just absolutely love Robert to death. He's fantastic. Reach out to him and he will equip and empower you with the information that you need. Let's go ahead and talk about active residential inventory. As of this morning, we are at 15,350 active listings currently on the market. This is the entire MLS. 129 daily change from Friday, 104 weekly. So we're now seeing some weekly positives. We were on the negative for quite a while. Now we're on the positive. Month over month, we're down 153. We had 153 more listings same day last month than we have today. The reason why we're negative is because of all the withdrawals. If half of the withdrawals were still on the market, we'd be on the positive. So we saw a huge surge on the number of withdrawn listings. That's what caused the number of active listings to go down. So when you see that we're not hitting record highs on the number of active listings, it's not because demand all of a sudden increased. It's because they simply took those listings off the market. Month over month down shy of 1%. Year over year, we're up 26.7%. Here's the pending. We're at 4148 right now, and that is down 13% year over year. That's going to give us an activity index of 21.3%. Months of inventory at 5.44. The activity index for resale, 17.7%. The activity index for new construction now down under 30%. It's at 29.45%. So we are noticing a drop in the activity index, not only for resale, but now also for new construction. That's something that we haven't seen. When you look at the number of active listings, we are up 26.7% year over year. Red line last year, dark bluish, purplish line this year. Last year, we had 12,114 active listings. Same day, by the way. We're comparing exactly the same day. And then we've got 15,350. Pending listings. Last year, 4,767. This year, 4,148. And there's the activity index. Last year, 28.5. This year, 21.3. So we're down 25.4% year over year. Keep in mind, you all, this is a leading indicator. That's why we can say with a high degree of confidence that this rate improvement that we saw, that we ought to take advantage of it, we ought to market the heck out of it, and we ought to position ourselves to help clients. What we're not noticing, and this ties in with, Mike, the question that you asked earlier, we are noticing a small bump. A very, very small. I'll take it. I'll take any increase, but it's not causing this like massive inflow of buyers. That's not happening at all. Walkthrough traffic for new builds. Very good question, Oliver. That's going to be published this next week. They publish that once per month, and that data will be updated this week. So we're going to go over that data on, if they have it by Wednesday, we'll go over it on Wednesday. If we have it on Friday, we'll go over it. That one right there, let me go ahead and show you where to find that data. Let me go ahead and just pull this up. This is going to be Team Price, Insight and Statistics. I add that report to the MBA Purchase Index, and this is going to be at the end of the MBA Purchase Index. And you can see that the last data that we have is actually for July 27th. It actually went down. It was came down to 27. So we'll get this data over the next week or so is when Wells Fargo will publish this data. But that's where we are, 27. It actually went down. We peaked at 34 for the month of March and April, and then it's gone down. But this stops in July, and the August data will be published here in the next few weeks. Very good question. But you can find that within the MBA Purchase Index. I just bundle those two together. Just makes sense for me. Very good question. But once again, we're not noticing a massive, massive increase in traffic. So I would say we're going to get a little bit of a bump on builder walkthrough traffic, but we're not going to see this massive increase. Months of inventory last year were at 4.18. This year we're at 5.44. And the previous record high on the number of active listings was 15,503. That was Monday, July 15th. 2 weeks ago, I said, give it 2 weeks. Or 2 weeks ago, or last week, actually, I said, give it 2 weeks and we're going to hit a record high. I would say that by next Monday, we're going to have more than 15,503 active listings. If we don't beat it, it's going to get really darn close, and then we'll just have to wait another week. Now, out of everything that's currently in the market, this is good news. We had a little bit of a backtrack on the percentage of properties that had a price drop. We were up to the 57%. We're at 56.8% right now, so that's really good. Let's take a look at type of market, because something has happened with the number of properties that are in a seller's market, buyer's market, neutral market that we have not seen happen in quite a while. Take a look at the zip code. We now officially have more zip codes that are neutral plus buyer's market than we do in a seller's market. And we have not seen this happen in a very, 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 very long time. We have to go all the way back to 2013 or so. But right now we have more zip codes. We have 23 zip codes that are in a neutral market. 31% of all the 75 zip codes are now labeled a neutral market. 16 out of the 75, or 21%, are now in a buyer's market. And 36 or 48% are now in a seller's market. And y'all, when you look at leading indicator, we knew this was going to happen. We've been talking about this. We knew this was going to happen. The next few zip codes that are going to transition into a buyer's market, 03. I'd say the only two are going to be 03 and 58. Within the next 2 weeks, 03 is going to be in a buyer's market. What about zip codes that are going to transition into a neutral market? We've got quite a few. We've got 38, 53, 78628 Georgetown. And I would say anything that is over 4.75 within the next 10 days will transition over to a neutral market. So Melanie Price just said, I just printed this out. Yeah, this just happened this morning. Aaron Dunnigan said, with the Austin Luxury Network, I bet the 03 is already in a buyer's market. No doubt about that, Aaron. You're absolutely right. When you add all of the inventory that was on ALN, off, quote unquote, off market inventory doubles for that specific zip code. It doubles. You're absolutely right about that. When you look at type of market for cities, we're at 50%, 50-50 out of the 30 cities that we track. Half of them are in a seller's market. The other half, a combination of a neutral market in a buyer's market. Let's take a look at the cities that are going to transition into a neutral market. We've got a little bit of time for Bastrop, Burnett, Smithville to transition into a buyer's market. Those are going to park there for a while. But when you look at that 4.75, you've got Elgin and Georgetown. Both of these over the next 14 days, based on the existing activity index, based on what's currently going under contract, ought to transition over into a neutral market here in the next 10 to 14 days. So that's the type of market city, type of market zip code. We went over active residential inventory. Let's take a look at activity index. And this is where I want to share the new resource that I put together for you. You know what? Before we do that, because it's already 10:53, I'm going to go to market cycle first. I'm going to end the meeting with the new resource. Here's the good news. Prices actually went up July. This number was negative on Friday. It's positive today. Agents are still uploading the sold information going all the way back to July. That caused this number to go positive. So not only did we have a positive month-over-month average sold price for July, we've got a solid positive so far for the month of August, not only on the month-over-month, but also on the year-over-year. We don't have that on the median. So what does that tell you? Well, that tells you that the expensive homes, the 90th percentile homes, the 75th percentile and above homes, that product is moving. This right here tells me that the slowdown in the market is actually happening in the bread and butter. Now, does that mean that the luxury market is not experiencing an increase in inventory? Everyone is experiencing an increase in inventory, but we've got more homes that are selling within the higher price points. It is only the 12th of the month, so we do see more expensive homes selling in the first half of the month as opposed to the second half of the month. Someone who's buying a $2 million property, they could care less when they close. Close on the 3rd of the month, who cares? Someone who's buying a $500,000 property, because you prepay your interest, right, from the day you close to closing, they want to close the last day of the month so that their closing costs can be less. So that's why this number is always higher at the beginning of the month, and then it starts going down. So that is a trend that we've noticed historically. The data shows that, the data proves it. So where are we from the peak? On the average, we're down 12.96%. On the median, we're still down 20.91%. When you compare the median sold price to 24 months ago, we are down 12.34%. 36 months ago, we're down 7.45%. And the last thing that I want to share with you is going to be this resource right here. Where are we on the defining the status of a market crash? Well, 3 more months where these two lines are under 0.6 and under 20% officially defines the market as being in a market crash. Right now, I still categorize the market as a moderate to high risk of a market crash. We're still in a severe correction, right? This is a 10 to 20% drop, 1 to 2 years. Only when the new listing to pending ratio for a 3-month period is under 0.6 and the median sold price compared to 3 years ago is under 20%, do we officially can define this as like, hey, it is what it is. It's a market crash. Right now, we're in a severe market correction. That's where we are right now. Now, really quick, before I show you the activity index, let me show you really quick what's happening with the leasing side of things. Because when you look at the market cycle for lease, we are noticing something similar happening to the leasing side of things. I want to open this. This is fine. Let me go ahead and just make this a little bit bigger. We now have, take a look at this, August. The average leased price for the month of August so far is $23.74. That's down $100. Year over year, that's down $102. On the median side of things, we're at $2,200. That's down $50 month over month, also $50 year over year. Now, where this is important is this right here. When you look at the median lease price versus 2 years prior, we're currently down 4.35%. Hasn't it gotten harder to lease properties, you all? Haven't tenants gotten way pickier? I mean, is it just me or are tenants like unbelievably picky right now? It's like, y'all, I just showed you 20 properties. Like, what do you mean? Like, yeah, tenants have gotten absolutely, Melanie says no, Bertina says yes. You know, I feel like tenants have gotten way pickier. Why do you think that tenants are getting pickier? Well, take a look at inventory. This was just updated this morning. We have 6,888 active properties that are currently for lease right now. That is amazing. Melanie, what's happening? Feel free to unmute yourself. Go for it.
What's happening is these landlords want to overprice these trash properties and not paint, not clean the carpet. They're absolutely disgusting. There's stuff running from the refrigerator. Like they're not presenting these properties in a way to get them leased. That's the problem.
Well,
Because the good ones, the clean ones, they are leasing.
Well, you know, and here's the thing. I'm really glad you brought that up, Melanie, because with this data, you all, and you're absolutely right, Melanie, right? You're absolutely right. With this data, you know, just like on the residential sales side of things, where there's always the tale of two markets. Remember back in the day on the sales side of things where you could put up any property in the MLS. It didn't matter what it looked for. It didn't matter what kind of marketing you did. And you know what happened? It would lease immediately, right? Or it would sell immediately. And we realize on the sales side of things, hey, the market's changed. There's way more inventory right now, so the listings have to be exceptional. The exceptional ones that are priced right, they look good, feel good, smell good, taste good, they're going to sell. And then you have the other properties, you don't want to be in no man's land, and then you have the trash that's never going to go anywhere. The same thing is happening on the leasing side of things, where you've got the tale of two markets. You've got the properties that are priced right, landlords that realize what's going on. They can look at this data and they can say, wow, my zip code has a high vacancy. My city has a high vacancy. Prices are going down within my zip code. That property down the road looked good. Everything was great about it. And it leased for $50 a month less than it leased last year. Okay, so I've got to present this product in its best light. I've got to price it right. I've got to make it look good. Those properties are going to lease, but then you've got what? You've got everything. Tenants have options right now. Tenants have options. So the same thing on the residential sales side absolutely applies to the leasing side. Tenants are going to get pickier, not only because they see the availability of inventory out there, but also they have options. They have a lot of options. So that's what's going on. It'll continue to happen, you all. So Bertina says, good point, but I'm seeing both sides. I agree with you. Plus the agents who don't want to communicate to get it leased. It's very hard to get a hold of leasing agents. It's unbelievable. Iden said landlords, let me go ahead and just read her. Landlords are getting stricter, almost like when you were buying a house, requiring 650 credit score, 2 years taxes, and who knows how many other things. That's also why I think their houses are not renting. And then we've got Melanie. I had 2 lease listings where the landlords priced competitively and clean, and they leased out first weekend on the market. And there were multiple properties in each neighborhood sitting on the market for months. And Alejandro said, I agree. Qualification criteria is way more strict by the property management companies. All of those are true. And that right there is an indication of the overall economy, right? Landlords are dealing with more evictions. Let's take a look at Eviction Lab, see what's going on here. Eviction Lab Austin, and what's happening with evictions in the city of Austin, Travis County. So we're above pre-COVID levels on eviction. I mean, we are up 20% from average. That's for June. That's the last data. And you can see the map. Take a look at Pflugerville. That's going to be your number one eviction area. It's going to be the 78660. And from there, we've got 78753, 78758. These are going to be the top zip codes when you're looking at evictions. So guess what those property managers and landlords are going to be doing? Stricter qualification. So the same standard that we have when we list a property for sale ought to be when we list a property for lease. I love what Melanie said. It's like, hey, you've got to price it competitively. It's got to be clean. It's got to be presented well. Draw in those tenants. Do not sacrifice your criteria. Professional photos. I agree with you, Melanie. And just hit it hard. But there's way more competition right now. Way more competition. So last thing we're going to go over, y'all, is this new resource that I have for you. And I'm telling you, I don't know that I've been more excited about a resource to show you. Because, is Aaron Dunnigan here? I don't know if Aaron, if you're in a position where you can unmute yourself. If you're not, that's totally fine.
I'm here.
Okay, good stuff. So, Aaron, you and I have spoken about this quite a bit. It's like the whole oh gosh, what's the activity index in the 78701 zip code in months of inventory? I know you've got a listing there. I know it's been a little bit of a challenge just to draw attention to that listing. So it's a discussion we've had, right?
Oh, yeah.
All right. So what I decided to do is break down both the activity index and the months of inventory per price range. So what's the price range for your specific listing in that zip code?
800.
800. So check this out, Aaron. You're going to love this. Look at that. Between 8 to 900, the activity index for that price range is 13%. In months of inventory for that price range is 10.5.
That's awesome. That's fabulous. Thank you. Wow.
You're very welcome. I'm so excited with this new resource, you all. So excited. Now, this is why and thank you, Aaron, for unmuting yourself. Super appreciate it. So this is why this is so important, because it goes back to the whole real estate's hyper-local. Demand for real estate's not only hyper-local when you look at location, but also pricing. When you look at the activity index for the 78701, we're at 6.9, more than 11 months of inventory. But what happens if you were to break this down per price point? You get some fascinating insight that otherwise you wouldn't have. So 0 to 200,000, well, there's no activity, there's no inventory. There's nothing there in that price. 2 to 300, what's the activity index? So the way that this is, and I'm still playing with the formatting. I really just cranked this out. I actually like the formatting. So this column percentage is going to be the activity index, pending divided by active plus pending. And then this second column is going to be months of inventory. And at first I had only the activity index, and then I had a separate spreadsheet for months of inventory. I decided to combine it. It requires a little bit of mental gymnastics to see where you're looking at, but I wanted these two figures next to each other. That's why I decided to do it this way. I feel like the two figures next to each other are a little bit more actionable, leading and lagging indicator per price range for each zip code and each city. So what does that tell you for the 3 to 400,000? Oh, so the 2 to 300,000, there's no activity index. What does that mean if you've got a zero activity index? That the only property, it's only active. There's nothing pending there. The only property that's available, or the properties that are available, are active. Nothing is pending. So you've got 3.8 months of inventory based on what's sold over the past 90 days. Then you've got the 3 to 400,000. What does this tell you? Well, you've got a 13% activity index, but you've got zero inventory. Well, what does that mean? That you've got properties that are pending, but nothing's active. Activity index is pending divided by active plus pending. So there's no inventory. That means that there's what? There's nothing that's active. Okay, so then here you've got fascinating trends. Really fascinating. You've got 7 to 800 zero activity index. What does that mean? Nothing's pending. And you've got 19.5 months of inventory, but nothing's pending in that price range. Look at the 5 to 600,000. You've got 3% activity index. Very few properties are pending. You've got 46.5 months of inventory in that price range. So imagine going to a listing presentation in the 78701 zip code, and it's a $550,000 condo. See, before you were looking at, okay, 6.9 months of inventory, or a 6.9 activity index, 11 months of inventory. Yeah, that's the entire zip code. That price range in that zip code, you're just getting slaughtered. You got 46 months of inventory. That's almost 4 years worth of inventory based on the current level of absorption and on what's on the market. Well, that plummets down to 10, and then a million plus 11.8. So let's look at a few more things right here. Really insightful data that we can see. Look at the 78741. So the way that this is, you've got red means hot. Right? Red doesn't mean stop. Red means hot. Blue means cold. That's just the colors that we chose because of the range that we use. When you click on any one of these, by the way, it just takes you to that exact document. So here you've got kind of blue is cold, red is hot. It just makes sense. That's why we decided to go ahead and just make it the same way. So by the way, these are all hyperlinks, takes you to that specific document. So really fantastic tool that you can use as you are working with clients, looking at different price ranges that your client's interested in. Really just amazing, fantastic tool. I'm so excited about this, really excited. And you can see right here, look at 78664 Round Rock. You go from 6.3 months of inventory, 4.4, 2.4, 1.8. So what price point is moving the most? Okay, the activity index, 39% between 4 to 5. That's good. 27, that's good. 31, that's good. But then look at the 7 to 800,000. It just plummets. The activity index drops to 20%. And all of a sudden, you've got 12 months of inventory. That's just amazing. Now, all of these different price ranges, but when you look at the 78664, you've got what? A 21.6 activity index and 4.03. So 4.03 is not bad. That puts you right around that neutral market. But Within that neutral market, you've got the 700 to 800,000 that's just getting clobbered. So this is going to give you way more insight so that you can be best prepared to go to that listing presentation, to go to that buyer presentation. Now, this is what I'm considering doing. It's going to take an obscene amount of time for me to do that. If this is what y'all want, I certainly don't mind doing that, but this is what I'm thinking. I'm thinking about, there's no way that I can add more lines to this. So what I'm thinking about doing is replacing this, the total number in percentage, which is really not that actionable, and replacing this with activity index and MOI. Okay? Activity index and MOI. So now between the 250 and 300, you'll see the activity index and you'll see the months of inventory. So then now this will be updated all the time. It would require me to get rid of this. So what are your, go for it, Melanie.
Yes, I think that is an amazing idea. That's perfect. It also keeps us from having to find a whole other chart, and putting it all into this one, compacting it, I think is amazing, especially for like listing presentations, because we go through so many things, like so many documents, so many charts, that I think this would help a tremendous amount.
Good stuff. Good stuff. Love it. Love it. Yeah, I like having it here, right? Because like this doesn't really matter, because you can see really quickly, okay, this one has more listings. Okay, 26.8%. It's like, okay, whatever. Maybe I'll have the total. I'll play around with it. I might be able to squeeze like one line, have 3 lines. So maybe like the total number and then activity index MOI. I'll play around with it. The less formatting that I can do here, the better. It'd be so much easier just to go ahead and just do the, I'm just going to have to do that. I'm going to activity index months of inventory, because now you go to a listing presentation, like Melanie said, if you want the entire resource to compare, great, you've got it. Like this is here to stay. I love this. I'm super excited about this. We've got it available not only for the top 75 zip codes, but also cities. And boy, this is super insightful. It's unbelievable how insightful this is. What's the highest one right here? Look at San Marcos. He got 45 months of inventory on over $1 million. That is not moving at all. That's not moving. But look at Marble Falls, 400 to 500. You've got 25 months of inventory. Just unbelievable. Lago Vista, 25 months of inventory. So this is going to stay. But based on y'all's feedback, I like the idea of just going ahead and just replacing these 2 lines, activity index, months of inventory. You get your summary for the city, for the zip code here on the bottom, but then you get each one of those data points that are specific to that specific area, price range. So I'll play around with it, So I've got a question right here, Daniel. I noticed that you unmuted yourself. Go for it, and then I'll answer a question.
I did. Thanks, Dan. I step out for a second here. I didn't get it if that's already available for us, if you're still working on it, this new chart.
Yeah, very good question. Let me go ahead and just show this to you. It is available. It's good to go. So if you go to activity index zip code or activity index city, it's already live, good to go. Scroll down. I put this all the way in the back. And as you can see, it's already there. Already there, good to go. It'll be updated, 3 times a week. So all the information is already there.
Okay, thank you.
Absolutely. So we do have one question right here, a direct question that was asked. Can you explain why Taylor has a 100% activity index? Yeah, absolutely. So let's take a look at Taylor. So right here within this price point, so you have to look at it within this price point. What a 100% activity index means is that within this price point of 0 to 200,000, everything that could be pending is pending. So the activity index is pending divided by active plus pending. So if you have 1 divided by 1, what does that give you? 100%, right? So if you have that's what it is. Pending divided by active plus pending. So if you have a 50% activity index, it would be where you have 2 divided by 4, meaning 2 are pending, 2 are pending plus active. So you've got 2 listings that are pending, 2 listings that are active, that's going to give you a 50% activity index. Out of anything that could be under contract, half of it is under contract. A 100% activity index is out of anything that could be under contract, everything is under contract. Simply, there are no active properties within that price range within either that zip code or that city. So a 25% activity index would mean you've got 25 pending, and then you've got 100 active plus pending. That's going to give you a 25% activity index, right? 10% activity index, you've got 10 pending, and you've got what, right? You've got 100 that are active plus pending. So that's the way it's going to be. Very good question. I always ask these clarifying questions, by the way, you all. Don't ever walk out of these meetings like, oh, I know you went over this again. No, I know this is kind of complicated just to get a really good grasp of, but I'm really excited about this new resource. This was a combination of the gentleman that came here on Friday talking about, hey, in this city or this zip code, I mean, let's take a look at the 78746 really quick. 78746, look at this. Over $1 million, there's 8.7 months of inventory. That's not that bad. That's not that bad at all. So what I do plan on doing, you all, is just doing one that shows everything, right? So, and that'll be right here on this one. So when you go to Insight and Statistics, we do have one for like all, for absolutely everything. So I'll have one for everything. So active residential inventory, we do have one for absolutely everything. So I'll have one for everything. I'll keep on playing around with this. So right here, entire MLS. This will be the first one that I will update. This right here will be updated here shortly. So I'll play around with this. I'll create the formula. So really, really excited about this. But this will be updated. I'm just absolutely stoked about this. So there you go, you all. This was a new resource that I wanted to share with you all. Really, our goal here is just to always equip and empower you with the absolute best resources. I've got a few comments right here over chat. Good stuff. Thank you. We've got thank you. Wow. Thank you. Yes. This is amazing. Rob says, I was thinking about using this in my next listing presentation. Absolutely. That's what it's here for. And y'all, any feedback that you all have, please reach out to me. Just let me know any feedback that you have. We always want to make just these resources the absolute best possible resources in the world for you. If there's a way to generate it, I will figure out a way. So there you have it. Really excited. Good news on the bond market, down 2.7 basis points. That is good. We're still a little bit far away from that repricing line, but I cannot stress enough how important this week is for rates. We could see one of two things. We could either see this go down, cross that repricing line with better than expected inflationary numbers. That almost creates a guarantee that the Fed is going to lower rates. The market's going to react in a very favorable way. And if we get a worse than expected inflation number, I certainly hope that's not the case, then you can absolutely expect rates to go up. Well, you all, if there are no questions, comments, concerns, criticisms, or complaints, I want to remind you that we do have our mentorship meeting tomorrow here at the office at 10 a.m. Be sure to join us. It's not only for new agents, it's for really anyone that desires an environment that's going to be encouraging, empowering, accountable. Accountability is a big part of it. We ask tough questions there. We encourage each other. And it's all about just, are we going in the right direction? Are we doing what it takes to succeed in this business? Then we've got our Wednesday contract review. Be on the lookout for the new contract proficiency challenge. That's going to be sent out today, due on Friday. We're going to review last week's contract proficiency. We're going to do a Q&A, and then also we're going to have a main topic that we're going to go over. And then, of course, we've got our Friday meeting that we're going to be doing. So be sure to join us for all of those. And last thing I want to say is that today at midnight is when the MLS no longer publishes the commission amounts. You should be ready for this because we've been going over every week for the past 8 weeks. Take this opportunity to watch some of the previous training that we've done. Look over all of the information that we've been publishing. We've done, I think, 9 contract proficiency using the new forms. So you should have done at least a few of those. So you should be totally familiar with those forms. We've been going over those. I will polish up a really nice flow chart to help you through this process. And if there are no questions, comments, concerns, criticisms, complaints, thank you all so much for joining. Super appreciate it. I will see you tomorrow morning at 10 a.m. Melanie Price, last words.
Okay, I have one more question. Are you sending out a contract proficiency today or?
Yes.
Okay, perfect. Thank you.
You're very welcome. Good question. Yes, be on the lookout. It will be sent out today. Well, that's it. That's all I have, you all. Have an absolutely amazing day. If you have any questions, comments, concerns, criticisms, or complaints, please let me know. Here to help, and I will chat with you later on. Have a good day.